If so, you'll remember how the bulls toss their horns at those courageous runners and the matadors. It's a sudden movement from below upwards, and the traders who buy in anticipation of a similar upward thrust in price are called bulls too. The awesome grizzly bear is found in North America. They are renowned for having the most fearsome forelimbs in the world. Their mightiest strike is from above downwards. Traders who sell in the hope that price will fall into the abyss in the near future, as if a grizzly has given it the treatment, are called bears.
Alright, let's leave the zoo and get back to the market.
For the purpose of our illustration, we shall work like many beginner traders prefer, without a stop loss.
And what's the point of stop loss anyhow? We watch our position like a hawk, and if price moves against us, we close our position immediately.
Let's see how everything turns out. Remember, as I said, price was in the resistance area. Now, we were not kidding when we talked about the strength of levels. It's much more likely that a price will bounce off from a level than break through it.
But at this very moment, something happened. Fresh news hit the market, which boosted price up through the resistance level, where it remained from a few days to a few weeks. Let's review the mood of our three groups of traders.
The bulls are happy. They're very pleased with themselves. Life is good, but they're still hungry for more profit. If price falls back into the old resistance area, I'll buy more, thinks the typical bull. The bears are despondent, close to stupor. The thought of their probable losses if they close their position at the current price, coupled with the negative effects of leverage, transforms the ferocious bear into a mongrel, howling in despair on a cold, rainy night.
Yes, the road to hell is truly paved with good intentions. The bears are thinking that if price dropped just a little bit, everything would be okay. Here's the resistance level. They saw price break through. They wanted to close their position, but they hesitated, hoping that the market would turn their way. It could have, but it didn't. If they were given another chance and price returned to the old level, they'd buy. There's no question of it. They've learnt their lesson. They'd close their position. So, the bears are also ready to buy at the old resistance level.
The fence sitters have been on the sidelines for too long. They were daydreaming. They woke up when price blasted up through resistance. Now the key roll of the broken level is clear to them too. They're ready to join the bulls, but only if price falls back into the old resistance area. So we've got another group of potential buyers.
Very frequently, fate gives all three groups their chance. Price very often drops down to the old resistance level as if to check its strength. But at this point, buy orders stream in from all three groups and price rapidly pushes up once more.
If price had broken out on the support level, the chart would be a mirror image, and the former support would turn into a resistance level, just like that.
So happy hunting, my friends. So now we've got a handle on support and resistance, we need to add more tools to our charting toolkit.
An uptrend is made of a flight of trading ranges upward, similar to bricks building a staircase. If we join the minimums of these ranges, we have a trend line, also known as a support line. This is the trend line of a bullish trend, an uptrend. If our short flight of stairs leads downwards, join the decreasing maximums of the ranges to form another trend line, the resistance line. This is the trend line of a bearish trend, a downtrend. And when support and resistance lines are horizontal, they are known as levels. And we have what we've already discussed, a trading range, a sideways trend.
So there's that word trend. It shouldn't confuse because
an uptrend is made of a series of rising local minimums and maximums. And a downtrend is a series of falling local minimums and maximums.
So now you know, that's an exact definition of trend. You may ask why I'm banging on about trend. What's the big deal?
Traders and analysts use the idea of trend in close association with trend line. Support and resistance lines provide us with precise measurable borders of the range of price, existing not only in the past but also in the future. Support and resistance levels give us future price ranges too. We need at least two local minimums, two troughs, to map a support line. Many traders will map this straight line only after there is a price breakout of a previous resistance level, and this is a reasonable strategy. Other traders plot the line earlier, when price passes halfway between points 2 and 3. Note that the formation of a fresh trend with precise borders can only be confirmed by a third testing of the support line, followed by a price rise from it. It's the same story for two local maximums to chart a resistance line. The trends gradient is easily measured by how many points price moved during the 5 minutes, the hour, the day, the week, depending on your chosen timescale. This is an important and absolutely objective measurement of the speed of the rise or fall in price.
Technical analysis was formerly and justly known as the art of charting.
When a trend line is being endorsed, the confirmation price sometimes does not reach the trend line, or, on the contrary, it crosses it. When this happens, it's advisable to plot a second trial line and let time be the judge. In this situation, we suggest carefully monitoring closing prices. They must be situated above the support line and below the resistance line. Some traders always use closing prices to chart a trend line. This method is especially easy to carry out using Japanese candlesticks. Here, all the candlestick bodies are situated above the support line.
But nevertheless, we strongly recommend taking the whole range of prices into account.
Let's plot a line in parallel to our main support line to give us a slightly hazy but precise enough boundary of price support. Soon we shall give you some numbers to calculate this hazy support.
It's possible to chart trend lines another way.
By identifying strong pivot points on the chart and using them to plot lines of support or resistance. The pivot point is a block of, say, 5 bars, where the middle bar is higher than its two neighbours on both the left and the right. In other words, it's a peak used for plotting resistance. Or vice versa, it's lower than its neighbours, and this trough is used to plot the support lines. We can be stricter still by requiring that the closing price of this middle bar is the highest or lowest close of all 5. In practice, we may have unwittingly used such points to chart our earlier trend lines, apart from observing the rule about the size of the closing price. Here are 2 more guidelines when evaluating the importance of a trend line. The more times prices touches and tests the trend line, the more valid that trend line is. So, a line that has been tested 8 times is more important than one which has been tested only 3 times. Secondly, a line which has held true for 8 months is much more important than an 8-week-old line.
With trend lines, by importance we mean reliability.
There is one more measurable characteristic of a trend. This is its width. To measure it on a bullish market, you have to find the peak which has risen the furthest from the support line. Draw a line through this peak parallel to the support line. This is the channel line.
These are the precise borders of our price channel on a bull market.
To map a similar channel on a bearish market, identify the appropriate minimum and draw a line through it parallel to the resistance line.
So these are the precise borders of the price channel on a downtrend. How can we make money with these lines?
When you are in an uptrend, what you do is buy near the support line. As price approaches the channel line, you fix your profit by selling. And when you go long, don't forget to set your stop loss a little bit below the support line. And how little is a little bit? Give it 10% or so of the channel width. Trust me on this one, it's a sensible risk. And even if W is around 300 to 350 points, our stop loss is no more than 35 to 40 points.
Now, the stop loss. Way back in the mists of time, when I was a young wet behind the ears trader, I can well remember my initial reaction to the term stop loss. Ha! What losses? I was young, strong and very, very clever. I was trading to win, period. But experience is an effective teacher, and I quickly learned here that the key word is stop.
The stop loss is careless, a guard dog for your deposit. You know, it's sometimes more important for a trader not to lose rather than to earn, especially if you're managing someone else's money. To get back to the price channel, you should note that opening a short position near the channel line of an uptrend, no matter how profitable it may be in the future, requires other confirmation signals and, more importantly, more knowledge and experience than you have at present.
So learn technical analysis. What else can I say about the properties of trend lines? Well, nothing lasts forever, and trends must come to an end. How does the end happen? Price simply breaks through the trend line.
The breakout of a trend line is a very serious thing. It frequently means the reversal, or at least a pause in the course of the current trend. And it is of the utmost importance to endeavour to filter out false signals of trendline breakout.
There are no cut and dried answers here, and it's impossible to avoid a modicum of subjectivity.
The first thing you've got to do to verify a breakout is check where the closing price is. If on the day of breakout the price closed below the support line, it can signal the beginning of a reversal. But this is insufficient for most traders, and they wait for price to remain outside the price channel limits for 2 days in a row. This strategy is known as the 2-day rule. It's the original time filter.
Why do I usually talk in days? It's probably automatic. The fact is that all the rules of chart analysis were formulated many years ago when traders predominantly worked with daily charts. Many terms, including the 2-day rule, come from that time. Everything we cover for daily charts holds true for weekly and hourly charts, but I can't vouch for minute and 5-minute charts.
There are also price filters which can verify a breakout. Different markets need completely different filters.
But now I'd like to focus on the specific trading tactics for the currency market, and in particular your tactics in case of a breakout. This should clear up a lot of questions that you may have about the validity of the breakout.
When price rises and breaks through the resistance line, no one is 100% sure whether this is a true breakout or not. So what do? Well, we place an order to buy 5 to 10 points above the trend line, and we place this order when price is no way near resistance to be on the safe side, because we don't want to be left sitting on the fence. We've already calculated the channel width, and we place our stop loss at 10% of W below the resistance line. Here, that's about 15 to 20 points when we've taken spread into account. Now, we need to place our take profit order, but the question is where? The most likely price target after breakout is that of the channel width W. And for our reference, we chart a line parallel to resistance at distance W. We aim to close our position 10% of W below this line, which is sometimes referred to as the double channel line. This is where we place our sell order to close the position.
Well, that's our sweet trinity of orders placed, and now we're going to look at a few different possible scenarios.
Let's take the channel width as 60 to 80 points. This means that price could reach target in 2 to 3 hours, leaving us little time to verify whether the breakout is true or not. If the channel width is more like 150 to 250 points, that's a realistic size, then price could reach the target line within 2 to 3 days. Here, we should recall Murphy's description how resistance lines as well as levels transform into support lines and levels after breakout. Price tries to get back into the old channel, a process that we call testing the line. That is, checking the strength of the former resistance line. We patiently move our stop loss and take profit orders parallel to the resistance line and the double channel line until the time comes that any one of them is executed. In this scenario, we have the time to think whether this breakout is true or not, to apply the 2-day rule or some other verification rule. What I mean to say is, we're only beginning to study technical analysis, aren't we? If after breakout price has moved more than 1/3 of W, then in all likelihood our boat will finally come in. Or, if in the first surge price breaks through the resistance level, the line can in turn become a new support level. It'll make our lives a lot easier because we can place our stop loss below it later, but only after price has reached a new maximum. This scenario favours us too. On daily charts, price channels can range between 400 to 600 points, and it can take up to 2 to 3 weeks for price to make its target, like on this Euro chart. However, the rules used to calculate price target and to set orders remain the same.
We'll move on to talk about some other methods of calculating price target in this, our section on correction.
We've just been covering breakouts on trend lines. Such breakouts frequently herald a change in the trend's direction. Only time will tell whether it will be for the short term or an intermediate period. Movements against the main trend's direction are known as corrections.
How far can a correction go? Is it really possible to calculate the probable price target? Yes, it is, but with varying degrees of success.
For simplicity's sake, let's take a bull trend. First off, we need to examine what's happening with the main trend. Find the lowest pivot point where it all began. We choose the candle with the lowest low in this pivot point. Now, where's the highest high of the highest pivot point? There you are. The difference, H minus L, is the price movement in the direction of the main trend. Now, we plot a line from the highest high so that it's perpendicular to the horizontal line through the lowest low. We divide this vertical line into 3 and into 2. We are left with 3 points, a third, a half and 2/3 of H minus L. By projecting horizontal lines through these points, we have our correction levels. These values were put forward in the 19th century by Charles Dow. Half a century later, another well-known analyst, Ralph Elliott, proposed the more refined values of 0.382, 0.5 and 0.618 as correction levels. The majority of modern traders use these correction levels.
We call them Fibonacci levels. Why? You'll have to wait for our film on wave theory to find that one out.
Corrections cease very frequently at Fibonacci levels, and price goes on to move in the direction of the main trend.
When is a price movement a correction and when is it a reversal?
While we are still in the shadow of a preceding trend, it's a correction. As soon as we leave the shadow, saying goodbye to the old ways, we are in a fresh trend. On a bearish market, all the reasoning and calculations have a mirror-like symmetry. Let's flip the chart over and check. It's exactly the same.
Correction levels are a powerful tool in technical analysis. All you really need to know is how to use them correctly. Well, we shall study, we shall practice, and we shall learn.
We've covered many new concepts today. How to plot charts, what time scale to use. We've explored the nature of the bar and the candlestick. We've looked at trends and support and resistance levels and lines. We've considered the properties of trend lines. We've also talked about correction levels and pivot points.
Don't worry about these new words and techniques. We'll be revisiting these concepts throughout our forthcoming films, and we'll be applying these techniques again and again. Practice makes perfect, you know, and you'll find that through time you'll be able to plot and use these lines very quickly. But the skills and experience to trade confidently on the market will come later.